ARB Corporation is small. It's an exporter, and it manufactures car parts, namely accessories for four-wheel drives. Now, this combination could have been a recipe for disaster, particularly during the economic downturn. However, ARB Corp's long-term growth record has been excellent. To tell us more, we have Morningstar Senior Equities Analyst David Walker. David, thank you for joining us today.
Thank you.
David, ARB Corporation reported results a few weeks back. How did they do?
ARB did really well. It produced a result with earnings per share growth of 15%, and the final dividend was 11% higher, and the company even talked about a special dividend. These are rare outcomes for small exporting Australian manufacturers at a time of local recession and global crisis and recession. And the result underlines why ARB is one of the best long-term small-cap investments on the market.
You mentioned an 11% increase in dividends and mention of a special dividend. Is ARB Corp appropriate for income investors?
The 2010 dividend yield is only 4%, which might not be high enough for some income investors. Additionally, the market cap at $300 million is less than the $800 million market cap cut-off threshold for the Morningstar income portfolio. ARB is more a small-cap growth stock, so it should be owned by experienced growth investors who understand small-cap risk. Having said that, the company has compounded its dividend at 12% per annum over the last 5 years. So income portfolios with a tolerance for some small-cap risk could perhaps consider a holding.
David, I think in the U.S., these sorts of, car parts manufacturers have not fared very well at all. What is the secret of ARB's success?
And in Australia as well, the local car parts market is notoriously difficult with many failures. The keys to the rare outcomes for ARB are good luck and good management. The good luck, we think, is the globally small size of the Australian four-wheel drive accessories market, which means that we think foreign players with lower unit costs and deeper pockets have never really been serious enough about the market to mount a competitive assault on ARB's position. We think this is an unusual kind of economic moat. It's evident in ARB's 2009 EBIT margin of 17%. Now, this compares with the kind of single-digit margins that most small manufacturers would consider themselves lucky to make in a good economy, let alone one afflicted by recession and global crisis. The other factor is good management, particularly maintenance of a strong financial position, steady but careful expansion of the store network, and relentless commitment to research and development. On the 30th of June, ARB ended its financial year with no net debt. The company's aversion to debt kept it out of trouble with its banks during the credit crisis, enabled it to make an acquisition, left funds over for research and development, and even puts the company in a position to talk about a special dividend. Careful management of cash flow has delivered or enabled another rare achievement, compound growth in earnings per share of 12% per annum over the last 5 years on the same equity base. Very few listed companies are able to deliver long-term double-digit growth without at least some equity raisings, but for ARB shareholders, the dividends keep rolling in without the need to write cheques.
How big a factor is research and development for ARB Corp?
Most companies cancel or reduce research and development during a downturn because the costs are up front, but the benefits are longer term. In contrast, ARB sees research and development as essential to its competitive advantage. Steady expenditure on R&D in 2008 put ARB in a position to release a new range of shock absorbers and a new fridge freezer for four-wheel drives early in 2009. These have been very successful, and the company continues to release new products worldwide.
Our strong Aussie dollar is expected to get even stronger over the year. What sort of effect does this have on ARB?
It dampens earnings and margins because it reduces the Australian dollar value of ARB's US earnings.
Does ARB face any type of downside risk?
The main downside risks are lower consumer and industry demand for four-wheel drives and their accessories, higher steel input costs, an appreciating Australian dollar, and higher fuel prices. Additionally, as the Australian labour market tightens again, ARB could find it difficult to, once again, hire enough skilled workers for its Victorian plant. And of course, there's always the longer-term risk question of whether an offshore player could get serious about the Australian market, in which case ARB might not be able to compete with its presumably lower unit costs and and deeper financial pockets.
Overall, is ARB's outperformance sustainable over the next, say, 3 to 5 years?
It'll certainly be assisted if increases in steel costs, which are likely as the global economy recovers, are gradual, if the Australian dollar appreciation is gradual, if fuel prices don't rise quickly enough to discourage demand for cars and four-wheel drive pickups and large four-wheel drives. Management, however, has an exceptional record of creative responses to adversity, which is one of the main reasons for the company's long-term earnings growth despite volatility that we talked about. For example, in response to shortages of Australian skilled workers to work at its main Victorian plant, ARB opened a plant in Thailand, which was highly successful. So this elite management team is the main reason to own the stock and one reason we remain confident.
David, thank you for your time today.
Pleasure, Vicky.